Welcome to the Commercial Real Estate Podcast. I'm Aaron. He's Adam. Remind myself to say powered by First National. Thanks, First National, for supporting us all these years. Recording here live at the Vancouver Real Estate Forum. Beautiful, beautiful setting. If you haven't been here, you got to come. I'd like to thank our sponsors, the speaker video series in partnership with the Real Estate Forums, ML Emporio Properties Limited, Remax Commercial. I'd like to welcome our guest, Trevor Blakely, founder and CEO of Forgestone Capital. Trevor, thanks for coming on.
Yeah, thanks for having me, guys. I appreciate it. And I echo it. Yes, a beautiful day.
It's nice.
Yeah.
I feel like it's always sunny when I'm in Vancouver, so I leave with this, oh my God, it's so amazing. But when you talk to a lot of people that are from Vancouver, first thing they say is, yeah, like 300 days a year, it's rainy. So if you can live through that, the 60 days of beautiful skies is worth it.
My advice, having been here a lot, come here between May and September, avoid all the other months.
Is that there you go.
That is the theory.
There's some dark gray days in between the other parts of the season.
Yeah.
So Trevor, you're from Vancouver.
No, I'm from Toronto.
Oh, there you go. Curveball.
Okay.
Never mind.
Yeah, it's okay.
We flew all the way out here just to do this. Tell us about Forgestone. Tell us about your career. How long have you been doing this?
Yeah, so I've been in real estate for over 35 years. So I started back in the late 1980s with Royal LePage, a name you still see in residential, but that used to have a commercial division that morphed into Cushman & Wakefield today. So I started in that and ran their investment division from about the middle of the 90s till the early 2000s. When Royal LePage was sold to Cushman & Wakefield, I went over to Brookfield and Brascan and started with a partner, their merchant bank, back in 2002, 2003. Spent several years there after some quite successful growth, and went over to BMO to revamp and start up their real estate investment banking practice. So did that for 8 years, and then woke up one day and said, I can't keep working for other people. I want to work for myself. So started Forgestone in 2013 with a partner. And we started small. We raised one single fund, and what we're 13 years later, we've done $8 billion of transactions. We have roughly $3 billion of AUM, and we really run three silos. We do value add opportunistic fund investing. We have an open-end debt fund that we are very active on these days, and we do segregated accounts for both high net worth international and pension funds. In fact, in Vancouver, we have $2-3 billion of assets either under development or under ownership today here in Vancouver.
So despite the fact that Aaron and I both work for a large institution, this podcast is fascinated with guys that throw off, the large corporate job in order to do their own thing. And obviously, looking back with this successful track record, it's looks like all glory. But back in 2013, how much fear was there, concern,
anybody that says it's all glory is wrong. And look, in their first couple of years, there are sure moments of doubt, like, why did I leave and what am I doing? And it does take you, a year or two to get your cadence. Because I was a broker, I had to train my mind to think like a principal, like an owner. And I have to admit, it took about a year or two to get off the mindset of being deal-oriented versus doing the right thing. So for sure. And then you get volatility in the market, all sorts of different things happen that you kind of second guess, like, what do we do now? But, everybody's in the same soup, and good or bad. And what you're really trying to do is just differentiate and do better than the majority. In the last couple of years, everybody's returns are down or negative. You just don't want to be the most negative, if you know what I mean, and thinking about what you do in the future. So yes, a lot of thinking goes on through all that period of time. But if I'm truthful, am I happy I made the move? Absolutely. And looking forward to the growth potential for the company and the industry over the next 5-10 years.
You on the equity side, value add and core, sounded like.
Yeah, so we're value add opportunistic, and it's a closed-end fund strategy. We're just doing our fifth fund right now. We do core investing or core build a core for segregated accounts, and each strategy on the segregated accounts is very bespoke. It's we work collaboratively over months working out the strategy, and then we do the implementation. And the debt fund, it's funny how we got into the debt business was simply based on the fact that people, our pension funds, are asking us to do core plus investing, and we couldn't come up with a strategy that we felt was viable.
For the risk.
For the risk. Yeah. So we just pivoted to debt and started growing that business. And quite frankly, in the current market environment, we are far more active on debt than we are in equity.
Yeah, capital is king right now, and there's not a lot of it going around.
Yeah.
Has your investment thesis changed from 2013 to today? What's the kind of core location, geography? What's the strategy?
Sure. So it's Canada. Your investment thesis, it's not dynamic enough. In the U.S., you can stick to the same strategy for decades because it's a big enough market that you can get away with it. In Canada, you have to move with trends in the market. So, initially we did a lot of, let's just say, value add income producing properties in the early part of our growth, and we immediately pivoted to condos. So we did bought land, entitled it, and sold it. We did some development. And we did partnerships. We did some directly. So, and then in about 2019-20, we pivoted to industrial. We saw the trend and we moved towards industrial. And then in our current iteration, given the lack of capital that's in the market today, we're almost exclusively now structured product and debt focused because we don't see the value proposition in equity. There's too many unknowns and volatility in the market to justify making an equity
Real
investment.
estate's really expensive right now.
Well, it's expensive, but you can remember, real estate, there's two ways to make money: the cap rate compression and growth. And if you don't feel either are moving in the right dynamic, then stay away from equity. So that's why we're more focused on debt.
So 2013 launch till current. 2013 to 2020 would have been more of a stable growth period.
Well, you just mentioned there was sort of consistent cap rate compression and rent growth in all assets of the business, basically, right?
Well, again, what you're capitalizing on in real estate is momentum. So you can get wrong on it, but you kind of see the trend, and you're capitalizing on whether it's cap rate compression, rental growth. But you have to pick your sector and timing, and you kind of got to be all in on that theory for that period of time. But as soon as you start seeing everybody pile in, you got to get out. So you don't have to be years early. You got to be 6 to 12 months and pivot. And what's the next thing? And for the last 2 years, we have really attempted to find where the equity angle is, but it just doesn't. It's not clear to us. It's not obvious. So we've just doubled, tripled, quadrupled down on debt.
Let's talk about the last 5 years,
where things were not steady.
Well, yeah, like I mean,
Growth.
before we went live, Trevor, you had said the challenges and the change that we've experienced leading up to where we are in 2025. I mean, it's flat cap rates, flat rental growth in all aspects for the most part. We've just come out of an incredibly turbulent environment, via COVID and everything that kind of transpired. We don't need to go there. I don't want to, relive that, but what lessons have you learned, and where you are today? You just said like it's tough to make it work. Other than debt, like, what are you trying to? Well, what's the strategy?
So take a step back, because you have to look at each cycle and what the implications are. So if we go to COVID, there's no playbook for it. Never existed. So the feeling at the beginning of COVID was despair. Like no one knew the implications and so forth. But the result of COVID was free money. So free money causes a problem, caused inflation, caused people being too aggressive on everything. And so as a result, we paid the price of then that correction with significantly increasing interest rates, which had the exact opposite effect, which killed cap rates and killed growth. And then ultimately go from that to the current environment where we're dealing with our friends in the U.S. and tariffs and everything else, and a change in government. All that uncertainty is not good for real estate. But the one thing I'll say, if we take a step back, different from the stock market, real estate is based on fundamentals. It's tactile. It's an asset. It produces income. So unlike a REIT or a stock, what we do like about real estate and why we're so bullish on it is there's less money around, whether you're playing debt or equity. You can stick to your guns and your knitting in terms of what you want to do and how you want to do it, and you can execute. And I think the next 2 years is probably the best time I've seen in the last 10 to 15 in terms of I think the right time, right place to be in real estate. You just got to buy right or lend right. And the criteria on that has to be much higher given the economic instability and unknowns we have in the market. So the bar's higher, but there's deals to do. And the reason you can be choosy is there's just less money going around, but you just got to pick your spot.
If it's the next 2 years, is that just predicated on start of the next cycle, or what are you seeing that contributes to that idea?
Yeah, sure. No one can predicate or predict what's going to be the next cycle. But what you're trying to take advantage is a lull in the market. So if you look at it from an historical perspective, the pricing is basically back down to 2016, 17 levels. That's how you got to look at it. You're looking at things like a replacement cost. You're looking at growth. You're looking at all sorts of elements that look at it. But the real thing is supply and demand. When there's less money and there's fear, historically, that is the best time to buy and to lend. When others fear, but it's about conviction in terms of what you're going to do, irrespective of what that is. So you got to focus on, what's your geography, what's your asset class, what is your business plan. But once you define that, you can't fear. You just have to implement, and more often than not, you'll be right. But in the moment, it seems like, why am I doing this? But that's the business.
One of the conversations I keep having here at the forum and elsewhere is just about, we're all in this very much holding pattern. There's an election in Canada, which of course has had some variable, all of the stuff that's going on geopolitically. And I keep asking, like, what's the tipping point? What has to happen for the momentum to change? Obviously, Trump's not going anywhere. The election will come out, but it feels like in all asset classes, rents are kind of max, right? We're seeing softening in apartments. We're seeing softening in industrial. Retail feels like there's not a lot of growth there. Obviously, office is still struggling from the effects of COVID. And then on interest rates, the cap rate side of that relationship, I don't think interest rates are coming down. I mean, you never know. Who knows what's going to transpire? But there isn't a lot of cap rate compression. So are we not in this, right? Are we not in this level where values are stable, if not flat, to coming down? And there's no next cycle where you get another 10 years of growth. Do you know what I mean?
Yeah.
Am I wrong?
You're not wrong, but take a step back. Never bet on cap rate compression as a business.
No, of course not. That's basically hoping interest rates come down, which means we're in some sort of weird economic uncertainty, right? Like it's just
and then the economy, for interest rates to come down, the economy is suffering, so that impacts rents and growth and all sorts of things. So it's more seen. Where to position yourself in the markets. I want to go back to your comment on the asset classes because we participate in all of them. So industrials being the most adversely affected because those are the businesses that are most severely impacted by the tariffs and the unknowns. So it's not that they are out of Canada, it's that I can't make a decision until I understand what the financial implication is. So that's a wait and see game. But we've had a 10-year run on industrial. So it's still fundamentally strong. It just, values have to adjust.
But everything year over year looks bad right now.
Yeah,
right?
But that's where I'm saying there's no value proposition in it. Pricing should be off 10 or 20% from what it is today. And then I think it's economically viable, but that takes time to get there. But if you take a step back, you talked about retail. Retail probably is the best performing asset if I had to segregate it because nothing's been built. We've had...
It's too expensive to build.
Correct. So everything that's there, if it's operated, run, like if you're merchandising right, your tenant mix, it's the right asset, you can grow those rents. So I completely disagree. There's lots of potential in retail. Like in anything, you got to buy, right? But if you can't build it, whatever there is there, you should be able to grow rents. I'll get back to office and residential, but let me start with office. If you're a 10-year player, 10 to 15-year player, office is the single best investment you'll make now because it's so far below replacement cost. Like it's half to a third. The return to work isn't going to change much, but people are coming back to the office. So I look at the relative value proposition. I think office is a great place to make a bet, but I think it's a 10-year play. I think in terms of being able to sell that dream to the next person, it's going to take 5 years of stability and so on and so
But
forth.
you made the comment, move before others do, right?
Yeah,
And
I you shouldn't be afraid of it. But what I would say, segregate office into 3 areas. First of all, be where people want to live, work, and play. And there's only so many cities, 2 or 3 in Canada where that is. The second part of it is look at the age of the building, the quality of the building, but it is so cheap relative. Like you can't build this stuff again.
We had Rob Kumar on. He was saying he bought something at an 8 cap, financed it at a 5% interest rate. He's get a 300 basis point spread. That they're chasing that spread yield, right?
But that's your best place to play. That in terms of getting cash flow yields. There's no better place to play. But in terms of the value play on it, I think it's going to take 10 years before the masses come back as an asset class and buy it. But from a straight yield play, I think it's an excellent proposition. On the residential, I want to pause on that because rental growth has stalled. So why is rental growth stalled? Well, there's 3 reasons. One, the shadow condo inventory. So people typically bought condos and flipped them and no longer can do that. So as a result, they have to rent them. It's like you basically built 300 rental buildings in the last year. Like that's effectively what's happened. So as a result, tenants are smart. They're saying I'm pivoting to those properties because I can get them at a buck a foot less or whatever a month. So they're moving to that. But if you look beyond 27, 28, there's no new supply. Last time I looked, we're still growing. Last time I looked, the major cities are still places people want to be. So I would argue I don't see colossal growth, but there's definitely going to be pressure on rents in the future. But when you're modeling, don't buy into it. Buy into the assumption that there isn't none, and then you make the decision then, and you'll be happy when it happens. But if my gut would tell me we're going to start seeing some rental growth in the strong locations where they have barriers to entry.
What I said repeatedly about rental growth, I mean, rent skyrocketed in almost every market over the last couple of years. If you give back 10%, you're still on an annualized basis over 3 years way ahead of the game.
You are, but just remember, it's harder to get tenants out. It's more costly to renovate space. It's more costly to build, although the costs are coming down. So when you look at it, it's still a tough picture. And I'll go back to my initial comment. There's no asset class that's easy right now. You got to remember too, Canada, even the major markets, there's a limit of affordability. So when you start talking about $5, $6 rents in your modeling, and I'm not saying you can't hit it in the right locations, but we don't have the wage growth that we had historically. Like, COVID, post-COVID, we saw 10, 15%. That stalled. That is inflation or down. In fact, unemployment's going to go up. So you got to look at everything in terms of a holistic picture. And again, when you're making decisions, don't bet on cap rate compression. Don't bet on rent growth. Bet on what's there. And if that makes sense, hopefully you've covered the downside, and you'll be pleasantly surprised if you get either of those 2 things happen.
How much do we want to get into U.S. tariffs effect? And this is a tough conversation because it's changing so rapidly, and we're recording here at the Vancouver Real Estate Forum on April 23rd, and this might not come out for 2 or 3 weeks. How are people supposed to pivot, strategize, react to it? I mean, opinions on where it's headed is one thing, but if you got real estate, you got deals in motion, you got projects, what do you do to safeguard?
Okay, you can't ignore it, but you can't stop doing what you got to do. So what I will guarantee is in the next 3, 6, 12 months, you're going to see all sorts of vacillation in that, positive and negative. It's not going away, but it doesn't stop you from doing your business. So again, you're looking at real estate as fundamental. So if you're buying, and the rents are at market and the leases are in place for the next couple of years, and you bought well, you should be okay. If you're developing, you've got to look at controlling your costs. So what do you do to mitigate that? You got to source it elsewhere. The good part is on the development side is there's certainly on the residential side, there's less work. So we're seeing downward pressure on cost. So that offsets some of that risk. So you can't stop doing something, but if something colossally bad happens, you pull out, you go to the sidelines. But right now, that's still unknown. And just like I said, Not that I ignore it, but I can't do anything about it. So in the meantime, just keep doing what you're doing.
It's interesting listening to you talk, Trevor, because the theme that keeps coming back to me is the fundamentals, focusing on the fundamentals. It's not going to be easy as it has been. Let's just talk again. We've referenced it so many times. The rent growth and the cap rate compression that's occurred in the past is not likely to occur in any kind of similarity in the future. So you've got to focus more on your operations, picking the right sites, and being focused on the fundamentals. Are there components of that you've had to work on? Like, I think of the operations. Like, we've been talking at First National just about our strategy and who we want to partner with going forward, and like there's way less tailwind, so you got to be a little bit more selective about who your allies are. And it really comes down to the best operators is the way we're kind of looking at it. The best operators will get the most amount of attention from us because we think that's where, if the sort of worst case scenario occurs, they're the ones that are going to end up still standing at the end of the day.
They won't lose the most, as Trevor said. Yeah.
Well, if you take a step back and talk about executors and operators in a growing market, whatever bad execution or not perfect execution gets washed away because you got it in cap rate compression or just general momentum in the market. So you're correcting the assessment that you're now narrowing the field. But these cycles are meant to do that. And in the last 5 years, in particular the last 2 years, 50% of the active market participants will no longer exist. Some of the individuals in those companies will go elsewhere, but the cream rises to the top, and you look at groups that are around for 10, 20, 30 years, there's a reason. It's not that they're perfect, no one's perfect, but they've been able to execute over a long time. They've got balance sheet support, they got deep bench strength, and more importantly, they're thoughtful and consistent in their thinking. So yes, whether we're doing a debt or equity investment today, who we're going to do it with is way, way tighter criteria than it will. And that probably is not going to change in the next 2 years. But how we see it is, and we seek out those partners. We don't wait for them to come to us. We, in each market and whatever they're doing, we identify them. And our goal is always, because we're not developers and we're not property managers, we're not leasing people, we're picking the best. And the goal is work with them on developing a strategy and program with them that we can do multiple deals. Your first deal is always the toughest, but if you get that and you've got, good collaboration and you've done the heavy lifting early, the goal is to do multiple deals with them because, real estate, for us at least, it's a partnership and we want long-term partnerships. So that's what we're thinking, but certainly, we had
the exact same conversation on our sort of executive team about just the relationship and loyalty and who are the clients that have behaved loyal throughout time, right? And that deserve our energy through this, because it's going to be harder. Like, it's just harder than it's been in a decade. And I like to theorize that there are a bunch of people that don't realize that yet, or that have only been in real estate for 10 years and haven't really needed to understand the fundamentals because they've been in it in such an easy sort of golden era, right? That we've had this conversation just last night. I was talking to somebody, to remain nameless, but they're like, 2 to 4 months and rents are going to start coming down and cap rates will start, or rents start going up, cap rates will start coming back down. We'll be back into the golden era again. That's not how it works, right? Like,
no. But you know what? That reality is as slowly and for the most part now is set in. But if you haven't experienced it, there's nothing that compares to living in that market. So you guys are too young to remember this, but I started in the business late 80s, but in the early 90s, it was the desert for 6 years. Like, literally, prices dropped like by 60, 70% over a 2-year period. And back then, the pension fund ownership was 20%, 80% was private. It's switched for most things now. But think about it, interest rates were 8, 9, 10%. The owners were the banks, and that had to all clear. So it is bad, and it's not bad. It's just kind of stalled. That was bad. And I can't, unless you lived, you can't explain that literally if you got one bid on an asset, you were jumping up and down. Like, it was but prices dropped 60, 70%. What if prices dropped here? Take office out of the equation, 10.
Yeah, max.
Right?
Yeah.
Now, should it be more? I would argue
well,
yes.
There's where you start to have this conversation, right?
That's my point. I think prices should be lowered. But
They aren't trading because of the institutional ownership. They can weather the storm. There's no
Can we go to
panic selling.
Can we go to REITs? And maybe we're going off topic here, but like just the discount to NAV conversation. Do you have any thoughts on that?
well,
Like I love this conversation because it's just this NAV, this variable of NAV, it's this real thing. I don't know.
REITs are punished too strong in a down market and rewarded too high in an up market. But they're repriced daily. So it's a way better gauge of value. And I'm not going to get into specifics because I don't need to. Do I think that some of them are undervalued now? Yes. Do I think they were overvalued at the top? Yes. But that's the nature of being public. The pension funds, and there's no way around it, the appraisal process is flawed because it lags on the way up and it lags on the way down. Everybody knows their assets, what they're worth, but we have to go through this process of slowly, because there's not enough anecdotal market evidence to actually, for the appraiser to pick them. They're not doing anything wrong. And, I'm curious, and I'll ask you guys a point. Will AI somehow take over part of that role because it's more intuitive to really what's happening in the market in terms of valuations? Because it's not correct how we're doing it now. So it's
always looking backwards.
Yeah. Like I said, you're lagging one way or the other, and it's not efficient. I don't know what the answer is, but the public markets is efficient. Whether you think it's right or wrong, it's efficient.
It's a daily opinion.
Yeah.
One way or the other.
Well, I mean that discount to NAV, and I'm novice when it comes to the understanding of all the nuances, but that NAV that's picked based on those appraisals are based on predominantly private market transactions because that's who's the only ones out there buying and selling, and who's to say that those private buyers are paying the right price? I mean, and that's, do they have the understanding?
Okay,
right, so it's skewed. You know what I mean?
Yeah, never. A deal is a deal.
No, I get that.
Whether
I
you
get
say
it was
it's
market
not market
transaction.
or
I know.
There's nuances, but a deal's a deal, and there's implications on why deals. But take a step back and you look at what happens, for both public companies and for the private buyers. Valuations do change. So if you're a REIT, there could be global events like we've had, and rising tide, lowering tide, they get hit irrespective of their performance. They are a proxy to what interest rate, because they distribute a yield. Same point, if interest rates go up and down, their prices go up and down. Is that correct? Yeah, I think it is correct. To the level it is, probably not, but that's the issue being public. On the private side and on the pension fund side, that's where I think where there's an issue, because intuitively we know both ways, up and down, that it's lagging, and it creates inactivity. So someone could say, I want to sell this asset, but it's valued at X. Well, how do you get around it? Well, just value it correctly, because you got to know it's lower. But there's a flaw in the system that.
So they all just sort of stuck.
They were stuck. We're no longer stuck now, because I think for the most part, the one exception I would say is on land, still has to be adjusted downward. But I think in all asset classes, there's enough trades. It's been 2 years of slowly writing them down or adjusting them. I think people have a pretty good handle. I think we're there now, which is good, because if you want to sell, it's not going to change now. So now's the time to do it. It's not going to get written down probably up or down. So you have to make a decision whether you want to sell or buy. So I think water's found its level. Do I believe, when you look at the market in terms of the economic and growth, that it's reflective of what I think the appropriate price is? I've said this before. No, I think prices should be adjusted downward a little bit more. But time will tell.
Do pension funds, like the investment committees that are, the high level at deciding what the portfolio mix looks like, that alternative asset class has grown over time because of the outsized returns we've been getting on real estate through what I'm dubbing now the golden era somehow. Do they change that? Do they kind of go back to, we're overweighted now, it's too much, particularly as they've been readjusting the values down? So
you're always tinkering, but it's not just allocation, it's geography. The bigger the plan, the more you're a global plan, so you're kind of looking elsewhere. For the most part, every pension plan has enough office, industrial, apartments, retail. And they may want to reallocate that based on trends a little higher or lower at the end of the day. The trend of late has been more foreign a diversification. I mean, most pension plans still, a majority of their assets are in Canada, which is okay, but I think the goal still is to diversify more into other markets. In terms of alternative asset classes, you know, whether it's storage or student or data, life sciences, they all have their trajectory, but you got to be an early adopter. And I'm not commenting on either of them because I think each one of them has different pros and cons in them right now, but you got to be an early adopter. So if you got on the train early, you benefited, then get off that train. Nothing lasts forever. And ultimately, that's the key on terms of whatever the new alternative is. But yes, they are all increasing their weightings. In some cases, I think they're a little late.
And reallocating is a lot of work and difficult too.
Well, where's the money coming from is the biggest issue. Because remember, it took a while for their pension funds to write their assets down. So that gives them more allocation. But with the sell-off in the bond and the equity markets, now all of a sudden their allocations go up just by proxy. So now again, they're constrained again. So the availability of money in the pension fund side of the business from a Canadian perspective is likely, well, for the foreseeable future will be lower. That's likely not going to change. And so ultimately, as you know, real estate practitioners don't expect that money to continue to grow. It's going to go the other way. And I think the natural pivot is not foreign. A lot of people think it's foreign ownership. The natural pivot is actually to the private sector. There's trillions of dollars of capital, and I would argue that has never been properly positioned to invest in vehicles, taking the volatility of the REITs and the stock market out into thing. So we're betting on this in terms of some of our growth strategy, but it's the private sector's era. In terms of pool capital, in terms of the next investment thesis, we're betting on it, and I think it's time for that to be done properly.
Last question, and then we're going to wrap up, Trevor. How is the fundraising, pony show going? Is that a lot of work, or do you guys have you're an institution, you've got the experience, you've got the same same players over and over again? How does that work?
Well, I'll tell you, 23 was you might as well have gone to bed and not got up. It was a complete waste of time for capital raising. Because you still had high interest rates, market, like completely waste of time. It started gaining momentum last year. We started raising more money last year. This year's been quite productive on both the private and institutional side. But the key on capital raising is actually listening. You can't say, hey,
I'm going to do this, I'm going to do that.
Industrial, we got enough of it. It's okay, but I'm better. You got to take a step back and say, okay, what's important? So what is important to investors today? De-risk. So let's talk about how you de-risk, whether that's debt or equity. So again, the bar is higher on what you're doing. Your ability to do something that they can't do on their own. What is that? There's no point people giving you money if they can do it on their own. So what is that differentiates your organization capable of executing that strategy? But the most paramount, most important thing for most investors today is yield. So I don't want the 25% return maybe 7 years from now. I want an annual monthly distribution and annual yield. So what we've tried to do is really focus, whether it's institutional or private capital, on developing programs, business plan strategies around reoccurring yield. And as you would know, because you're in the debt business, that's the one benefit debt has, is it pays a monthly distribution. Now for us, we're not A note lenders, we're B note and structured product lenders, but because there's a lack of equity, we're finding an abundance of opportunity and we're delivering yield. So that story has resonated with our clients. I think it'll continue to resonate, and that's going to be our path until, the next iteration comes up.
Trevor, we appreciate your time today. I don't know if you can hear in the background.
Just under the bell.
Yeah. They're calling people in the next session. We, of course, want to thank our partners, Canadian Real Estate Forums, for hosting us here at the Vancouver Real Estate Forum, doing the speaker video series. We do have some sponsors, which is Remax Commercial and ML Emporio Properties. First National powering the podcast. All of that said, most of all, Trevor, thanks so much for coming on today.
Guys, thanks very much for the time, and go Leafs.
Go Leafs.